Cool. Morning, everyone. It's a real pleasure to welcome you to today's Zaronia workshop hosted by the Standard Bank team. Thank you again for making the time to join us for what promises to be a rich and hopefully practical session as we go through the materials. As we join the call today, I think we do set a pivotal moment in South Africa's financial markets. The transition to Zaronia is not just a regulatory shift. It's a structural evolution that will really shape how we price, manage, and think about risk in the years ahead. And while a change of this magnitude can feel quite daunting from Standard Bank's side, we just want to assure you that we're not navigating this alone, and that there's a full team behind this from a Standard Bank perspective. From our side at Standard Bank, we've walked this road before. Many of you will recall the LIBOR transition, which was complex, multi-layered, and at times pretty uncertain. But we got through it as a collective, and we did so by staying close to our clients from our side, engaging early, leaning into the technical and legal detail with clarity and purpose. And from our side, we bring that same commitment to you as our client base from a JIBAR perspective as well. Standard Bank, as a group, has representation across all the key Zaronia working groups and is also leading some of the work streams in the Market Practitioners Group, which we feel keeps us close to the developments on reference rate reform and gives us a front row seat to the latest developments and ensures that we can bring you timely, we feel informed guidance as the landscape evolves. This is an evolving landscape, so it's important that we stay close, and we feel as a bank we are very close to the moving regulatory framework. So, while we're not just observing the change, we're actually, from a Standard Bank perspective, helping shape the change that makes sense both for ourselves and you as clients. And today, I guess we're especially proud to share something new in reference rate reform, which is the launch of our Zaronia calculator. The calculator is there to support our clients with Zaronia transition. So from our side, the bank has launched a loan interest rate calculator to help illustrate how interest rates are calculated using backward-looking risk-free rate benchmarks. And the team will explain this in a lot more detail as we go into it. So looking forward to that. From an agenda perspective, we've curated a lineup that brings together deep expertise and real-world insights. So from the start, Paul Burgon will walk us through the industry's key milestones and transition approaches. Following Paul, Vawani Ntakeni will share the key differences between JIBAR and Zaronia and unpack the credit adjustment spread mechanism, which is obviously an important conversation piece from our side. After Vawani, we'll move on to a legal panel led by Zwide Mhlongo, Davina Stock, and Kim Oliver. And each of them brings a unique lens across loans, bonds, and derivatives across our organization. So that should be very useful and helpful to everyone on the call. And following them, Junior Ramakumba will follow up with a market update from the desk. Many of you know Junior and engage with him day to day. So for us, it's a full agenda, and it needs to be so. I think we're heading into the back end of this year, and it's important that everyone feels that they have Zaronia to hand as we head into I guess, next year as it becomes a real thing. So for us, it's not just a technical transition. As I said, it's a strategic one. And hopefully by the end of today, you leave a lot better informed and from our side and your side, more confident in your ability to lead your organization through it alongside ourselves as Standard Bank. So from our side, welcome. We're glad you're here and looking forward to making it a productive and engaging session. So from our side, Clive Potter, who's responsible for the client franchise and CIB, looking forward to a very productive conversation on the call today. Just in terms of practicalities, what I'd ask is if you have a question or would like to post it, please post it on the chat function online. If you'd like to ask a question on the line directly, please wait till the end and we'll hopefully answer as many as we can in the time provided. So without further ado, I'm going to hand over to the team and look forward to the conversation and the time ahead. So thank you.
Thanks, Clive. And welcome everyone. Really glad you could join us today. It's great to see so many people on the call. I'd just like to orientate us. So where are we? And how much time do we have left for Zaronia transition? I think if you look at it, we're at the getting towards the point where we're seeing wide adoption of Zaronia across a range of market instruments, and we are shortly heading towards a period where we need to more actively be considering transition. So I'll run through some of these key milestones with you, and also just try and explain the kind of state of readiness of the market for the transition that we are going to see during the course of next year. So the foundational work took place during 2023 and into 2024, and that was really around building Zaronia, the successor rate, the primary successor rate for JIBAR, publishing that, building credibility around that rate through backtesting it. And we're now confident that we've got a replacement benchmark for JIBAR that is observable. We understand how it behaves relative to other reference rates like repo. And we've done the work to build the conventions around products. So what does the legal language look like for a Zaronia linked bond, money market instrument, loan, or derivative? And those instruments have been put into place. And then what was quite important is that we've, at an industry level, have also worked on adopting an adjustment approach. So building a credit adjustment spread, and Vuani will take us through that in some more detail. But really, when we move from using JIBAR to Zaronia, those interest rates are different. They behave differently, they incorporate different risks. And as we saw with LIBOR, it's important that we have a tool or a spread differential that allows us to transition at a market accepted rate. And that credit adjustment spread's been put into place. So now we're getting to a point where we've got critical milestones that we're going to see come into place. We've had, in the adoption phase, we've had the beginning of the Zaronia first initiative for derivatives that really asks market makers to use Zaronia as their primary quotation mechanism in the market to build volumes in the use of Zaronia. And we have certainly seen volumes pick up on LCH, on the clearinghouse data. We've seen those volumes starting to gather momentum. And I think that's important, a very important step. And it will also allow the creation of a term reference rate, which I'm sure we're likely to get questions on today. The ISDA protocol has been published, and the fallback language is available for use. And certainly that will very much ease the derivative transition, and the legal team will take us through that in a bit more detail. And JSE and Straight, they were able to facilitate market trading from middle of May, and we've certainly seen a healthy pickup in negotiable certificates of deposit issued by banks, and also we've seen bonds issued in the market. And certainly Standard Bank was very proud to be the first Zaronia bond issuer earlier this year. So where we head to now? The end of this year, we expect the SARB to formally announce the cessation of JIBAR. And what does that mean? That means all this work that we've put in to date at an industry level and certainly across the market, and all this understanding becomes real. We'll get a tangible cessation date announced. There's still some discussion around what the cessation date will be, but the guidance that's being provided to the market is that will be at the end of 2026. There's some practicalities to work out on whether doing a cessation at the end of the year makes sense. So those discussions will continue, but it'll be around the end of 2026 that we see JIBAR stop being quoted in the market and not being able to be used in transactions. So after that cessation announcement at the end of this year, that credit adjustment spread that I referred to earlier, which we'll go through in a bit more detail, becomes fixed. So it'll be a single spread for each JIBAR tenor, whether it's 1 month JIBAR, 3 month JIBAR, that's able to be used then to transition JIBAR linked transactions into Zaronia-linked transactions. In March, there's an expectation that JIBAR is no longer used in new transactions, and that's very important. So really, we're saying by March, we'll expect the market and market participants, our clients, our funders to be able to use Zaronia as an instrument in transactions that we do across bond, loan, money markets, and derivative markets. And I think those are really the key points. Other than a final one that you see on the bottom right, where we talk about tough legacy legislation. So on the next slide, I'll talk a little bit about the transition approach, and we will go into a bit more detail on the legal side of it. But really, how do we think about moving from Zaronia to from JIBAR to Zaronia? So certainly for new transactions, be fairly straightforward. We would use, for floating rate instruments, we'd use Zaronia as the base rate and add a margin. But for transition, there's a number of things we need to consider. So if we have a JIBAR linked exposure that's going to exist beyond the cessation date, we will need to amend the terms of that contract. And we can start doing that in new transactions now by putting appropriate fallback language in. So a lot of JIBAR linked transactions you would see would have fallback language in. And again, we'll expand on that in some more detail. But then how do we transition? When do we transition? When are we expecting derivative markets to transition relative to bond and loan, cash markets? Those are all under discussion at the moment at the MPG. So really the MPG through the transition planning workstream will be providing some guidance to the markets on transition approaches and guidelines towards the end of this year to facilitate discussion and dialogue between banks and their counterparties and other market participants that use JIBAR, and will have JIBAR exposures across at the end of 2026 that'll need to be transitioned. Active or passive. So is there an expectation that we actively reduce the amount of JIBAR linked transactions we have in the market? There certainly is that, and where that can be the case, there's certainly guidance from the SARB and the Market Practitioners Group that we do actively reduce the amount of JIBAR linked transactions we have ahead of the cessation date. And what are those pricing adjustments? So certainly we've talked a little bit about the credit adjustment spread. Is that appropriate in other markets? So there's more detail to come in potentially transitioning certain instruments to prime, where Zaronia may not be appropriate, and we think that's the case in the retail market. And we also think that the use of a term rate will be desired by the market. And to give some assurances on that, the industry is certainly looking at developing a term rate, and that's under discussion at an MPG level as well. But the guidance is that it's not certain that we will get a term rate. So it's important that we're able to use Zaronia in the forms that are going to become market standard, which is in a compounded overnight form. From a legal perspective, I won't go into too much detail here, but there's certain complexities. For bonds, you would need noteholder consent, as an example, to amend the base rate, to amend from JIBAR to Zaronia, and there's a threshold on the amount of consent you require. And so with all of these things, this guidance is going to come out. And lastly, on the tough legacy, so where we have transactions that we think will be difficult to transition, and the bond market might be an example of that, but equally retail markets, the SARB are putting in some primary legislation that will effectively legally transition any JIBAR linked instruments to an alternative reference rate, most likely Zaronia, on the cessation date. So it effectively creates a legislative approach to transitioning instruments. That we've got a balance with this desire for us to actively transition, for clients wanting certainty ahead of that, to maybe not be in a position where that legislative approach takes its course, and to actually actively renegotiate these contracts with counterparties. We're very pleased to have this participation today. We want to go through this in a bit more detail, and certainly we very much here to support our clients through this journey, moving towards the use of Zaronia. With that, let me hand over to Fawani to take us through some of the fundamental differences between the reference rates. Thank you.
Thank you very much, Paul, for that introduction, and good morning to everyone. Paul has laid quite a strong foundation for us in terms of some of the things that we will need to consider during the transitioning period, which is commencing very soon. In the next couple of slides, I will just be adding a little bit more just to look at the practical foundation that we actually need to take into consideration together with the CARES mechanism, as well as putting together an example, which will hopefully assist us in terms of actually visualizing the economic impact that we actually will need to manage through this transitioning period as well, that is commencing soon. In this slide, we're just really looking at the fundamental differences between JIBAR and Zaronia. This is quite important because it will set a lot of the background conversations that we're going to have in the next couple of slides. It's important to note is that JIBAR is an unsecured rate. It's forward-looking. In other words, it's a rate that we are all accustomed that is available upfront during the commencement or start of an interest period. Whereas we're moving out to a Zaronia rate, which is overnight by its nature, observed backward, and the interest rate will only be known closer to when interest is actually going to be paid. So it's important to note as well that by the fact that JIBAR is actually forward by its nature, or forward-looking by its nature, it will anticipate any monetary policy interest rate. In other words, it will anticipate what the SARB will actually do with respect to the change in the repo rate. On the other hand, Zaronia will only track that change as and when the SARB will actually make that difference, or that change in the monetary policy rate. And so those fundamental differences will actually give a rise to some form of premium that needs to be accounted for as we actually begin to transition. We've also tried to actually graphically represent to you on a graph that is to your left, how you can actually approximate JIBAR by using compounded Zaronia together with adding a credit adjustment spread as well. That combination of Zaronia, compounded as well as credit adjustment spread, is represented by the dark maroon or red line at the top, whereas JIBAR itself is the green line that you're seeing there. And you can see that even though it's actually not that slightly different, you can see that there is actually a relationship difference there that is actually arising, which accounts for this risk premium that we have been speaking about with respect to how JIBAR has been set in the past versus how Zaronia will actually begin to be set in the future as well. Another key thing to also note here as well is that Zaronia will actually be based on actual transactions that are traded in the market. In other words, overnight call deposits that are actually traded by banks in the interbank market, or in the wholesale market, rather, which is quite a big fundamental difference between how JIBAR is actually set, together with how IBORs would have been previously set as well, where this is actually based on a submission by contributing banks, notably the 5 top banks in the local market, will then contribute the rate based on their own expected indication of where that JIBAR will actually sit. So this is actually quite important because it ensures that we adhere to the IOSCO principles of how benchmarks should actually be set, in that they actually should be reflective of the market in which those rates are actually going to be used. And thus, because Zaronia is going to be used based on the wholesale funding market, it becomes much more principle-based in that regard. Now we're going to look at how the mechanisms of the credit adjustment spread, because this is important given the fact that we've just spoken about the risk premium that is associated with the difference between Zaronia and JIBAR as well. The most important point to actually note here is that the credit adjustment spread, it aims to ensure a fair process to transition away from JIBAR to Zaronia. It is not designed to ensure that there's full economic compensation. As Paul mentioned in the background that he provided us in the transition, he mentioned that the credit adjustment spread will be set for each various index of JIBAR, or each individual tenor of JIBAR. It is not meant to compensate for the term structure of individual deals. And we will see that when we actually go through a practical example. Some of the key dates that have been noted on this slide, I won't touch on because my colleagues from who will be covering the legal overview will go into detail in terms of what it means when the ISDA fallback public protocol has been published and etc. And it's available to the market as well. But I think what's important for us here is to note that the credit adjustment spread have begun to be published in Bloomberg, and certainly can be observed even though they're not yet fixed. And we're expecting those credit adjustment spreads to be fixed once formal announcement of JIBAR cessation has been published in the market. Now we're going to go through what those fundamental differences are and how do we actually think about transitioning as we think about the role of the credit adjustment spread. What's important to note is that we are replacing JIBAR with Zaronia plus a credit adjustment spread. In other words, an existing JIBAR-linked product or a deal will transition away from JIBAR plus a margin to Zaronia plus a credit adjustment spread plus a margin as well. A transitioning deal should ideally preserve the same margin pre and post transitioning. In other words, this is not the transitioning is only earmarked to only replace JIBAR as a benchmark. And this JIBAR will be replaced by a combination of both Zaronia as well as a credit adjustment spread. With the credit adjustment spread primarily designed to ensure that there is a fair economic value transfer pre and post LIBOR transition, pre and post JIBAR transitioning, I beg your pardon. It is a static adjustment which is made to Zaronia and should be expected to be in place for the duration of the contract that is being transitioning. In other words, even though JIBAR will cease in the future, a transitioning deal will reference Zaronia plus a credit adjustment spread for its full duration, even if that contract will mature beyond the cessation date. On the other hand, a new Zaronia-linked deal could actually have a different margin as compared to that of a deal that is actually transitioning. This is because the market will look to price differently or may look to price differently to account for the fact that JIBAR initially had an interbank credit spread that was incorporated in it, whereas Zaronia now is a near risk-free rate without that interbank credit spread, which market participants may or may not look to actually compensate through the margin. And I certainly think that those are some of the practical considerations or discussions that you will definitely have both between the lenders as well as borrowers in the market as well. I mentioned in the last couple of slides in terms of the methodology being published by the South African Reserve Bank as well. But what I actually wanted you to actually bring into your confidence as well is that the methodology that has been proposed, or rather been adopted by the sub or the MPGs, various MPGs, is very much aligned to the ISDA fallback calculation methodology. This being to determine the credit adjustment spread based on the 5-year historical median difference of Zaronia as well as JIBAR. And certainly this will be made, this credit adjustment spreads will be made available for all the various JIBAR tenors, as we have, as you can actually observe in the graph to your left. The most actively traded JIBAR point being the 3-month JIBAR point, you can observe there, it's the second one from the left. We are seeing that the credit adjustment spread is currently around 17 basis points. And certainly, if we use the same methodology that has been adopted, we are forecasting that by the end of December this year, that credit adjustment spread will still stabilize at around 17 basis points. This is good for the market because at least it can give you a better indication of the stability, as well as ensuring that you've got better certainty in terms of what that spread could actually set or publish once JIBAR cessation actually is announced. So we're not really expecting this spreads to actually move around quite a lot, but certainly we're expecting that there will be stability based on the methodology that has been put in place by the work streams that were tasked to actually put it together. And so this credit adjustment spread will become very important as we think about how we will price new deals, as well as how we transition, and certainly mainly for transitioning deals, I think it's actually going to become important. In the next slide, we've put together a practical example for you, which aims to actually show you what the economic impact could look like as we transition away from JIBAR to Zaronia. In this example, we look at a simple cash product. We assume a cash product with a principal amount of 100 million with a tenor of 90 days. We are going to use the same discount rate. And the reason that the discount rate is important is that it aims to demonstrate what the present value of a deal could actually look like. Now, if we look at the inputs to actually calculate the all-in interest rate, a deal that's currently referencing JIBAR will have JIBAR as a benchmark plus a margin. And in this instance, we've got a deal that has a margin of 150 basis points. Now, you'll recall that when we spoke a couple of slides ago, we mentioned the fact that we're replacing JIBAR with Zaronia plus a credit adjustment spread. It is for this reason that when you look at the transitioning deal, you can see that there's a benchmark there of Zaronia, which is that 7.457 that you're seeing there. And then we're adding a credit adjustment spread of 0.17 or 17 basis points. The reason that this 17 basis points is important is that in the previous slide that we touched on, we mentioned that the most actively traded JIBAR point being 3-month JIBAR, currently that spread is around 17 basis points, and we are forecasting based on the approved methodology that it will still be around that 17 basis points, even though it remains fixed. This is just based on our calculation at the moment. So if you add those two components together, plus the existing margin on the deal that's transitioning, you can see that there's a difference between the two rates. And this could be expected and should be expected by market participants. The primary reason that you're seeing this difference is that the credit adjustment spread is looking for a fair way to move away from JIBAR to Zaronia. In other words, it is not looking to compensate for the term structure of a deal. So it will never give you the same economic equivalence based on the term structure of your deal, because it is looking to replace the benchmark itself without actually looking through to the term structure of specific deals. Now, if we look at the interest amount or the calculation for illustration purposes here over the period of 90 days, assuming that Zaronia compounded in arrears remains at that rate, you can see that there's a difference between the two calculations of about 17,000 Rand in that regard. If we discount we use the discount rate at the top to calculate a discount factor, you will see that the present value of the interest between the two is also different as well. That's meaning that if you actually had to include the principal, the present value of both the principal as well as the interest amount, you are likely to see that there will be a difference between those two present values. And that's because of in this example, it's precisely because of the impact of transitioning from JIBAR to Zaronia through adding that credit adjustment spread and using a benchmark which is different to what we are currently accustomed to. This difference here that you're seeing of present value can actually have an impact also on mark-to-market as well. And in actual fact, it is also a representation in some way of the possible mark-to-market impact that market participants could possibly observe as they are transitioning. These are practical considerations that we will need to take into account as we begin to transition, as well as in some instances when we actually begin to price new deals as well. Now, the final slide is really just wanting to bring all this together for you and to consolidate it. We started by looking at what we are replacing. We are replacing JIBAR with Zaronia plus a credit adjustment spread. We should expect that a transitioning deal should preserve the margin on a deal that's transitioning. We then looked at what those credit adjustment spread are currently tracking or looking like. And we then took an example of the most liquid point being 3-month JIBAR, and we took that and used it to actually represent a practical example. And it's through this that we are able to observe that there may be some differences that we could observe as and when the credit adjustment spreads become published. I hope this gives you a better sense of the financial impact, together with the mechanism that has been used to actually calculate the credit adjustment spread and what those practical considerations could look like as we begin to transition away from JIBAR to Zaronia. I'll now hand over to Zwide, Davina, as well as Kim to walk us through the legal overview.
Start the session off. From a legal perspective, there are a number of considerations that we have to look at to ensure, a smooth transition away from JIBAR to the likes of your Zaronia. The three main pillars that we consider, that we look at or consider from a legal perspective are the following. So we have what we call our new Zaronia pillar. The new Zaronia pillar is simply where, counterparties enter into a new transaction referencing Zaronia. So it's not a matter of entering into the JIBAR rate, parties have agreed, if they are ready from a systems perspective, etc., that they will enter into Zaronia. And this is what I think the Derivative First initiative is also encouraging in respect, the Zaronia First initiative in respect of derivatives is encouraging, is to push parties to start looking at, entering into Zaronia as opposed to JIBAR, still using JIBAR. So in this instance, there is no transition process at all. The next pillar is what we call new JIBAR. So when we refer to new JIBAR, we're talking about contracts where or transaction where we still use JIBAR. So today, tomorrow, in a month, counterparties or parties enter into a new transaction still referencing JIBAR. In this instance, you've got to consider that JIBAR is going to be, going to end. There is going to be a cessation of JIBAR. So your contracts actually have to cater for this. Particularly the thing that you have to, or the most important aspect to consider here, if you're entering into new JIBAR, is the maturity date. So if your transaction matures beyond what we look at now in terms of the milestones, December 2026, that means that your contract is continuing, still referencing JIBAR. How are you going to deal with that or address that issue with JIBAR no longer existing? And from our perspective, I mean, we encourage parties to look at fallback language. You will note that if you enter into any transaction with Standard Bank currently and you enter into JIBAR or still reference JIBAR in your contract, there will be fallback language. Fallback language is there just as a safety net or a safeguard. So when counterparties enter into these contracts on the date of cessation, this fallback language allows parties to automatically transition to a new rate. In the instance of JIBAR, possibly or most likely be Zaronia, with obviously a specific methodology that will apply, or and conventions that will apply to that as well, with a credit adjustment spread attached. In the third pillar, we look at what we call legacy JIBAR. Now, legacy JIBAR is where we've got contracts or transactions that are still existing, may have been entered into a month ago, a year ago, 10 years ago, which still reference JIBAR, and that mature beyond the cessation date. In this instance, we should also be looking at how we can actually include language which allows us to transition very smoothly. For example, what I'd mentioned earlier, the use of fallback language. So these contracts for different products may need to be amended. For example, in the loan world, which as Rita will touch on, there may need to be an amendment to your existing contract to include fallback language, which allows counterparties or parties to transition smoothly. In the derivatives world, I'll chat about this a bit more when I speak about derivatives a bit later. There is the ISDA protocol, which allows counterparties to transition by merely adhering to the protocol on the ISDA website. So there's a multilateral amendment of your contract. So there's no need to actually physically or manually amend your contract if both counterparties have adhered to the protocol via the ISDA website. So in the derivatives world, I've already mentioned, there is this protocol which is in place in respect of legacy contracts. And if counterparties, and again, we encourage counterparties to look at this option, because once you're signed up, there's no action actually needed. It's a passive transition. When we talk about a passive transition, we talk about an automatic transition to the new rate upon cessation date without having to manually amend volumes of contracts that are impacted by the cessation or this transition. If there is if counterparties both do not enter into the protocol, we will have to you would have to manually amend your contract. So that would be a bilateral amendment of existing JIBAR-linked contracts using active transition. This is bilateral manual amendment of the existing contract. In the loan world, I know the LMA has done significant amount of work, which I'll leave Zwida to chat about, but there would actually have to still be a manual transaction or a bilateral amendment to contracts, because there's no option, there's no ISDA protocol or similar sort of tool in place. But there is wording which I believe that can be used in the loan market, which again Zwida will touch on. With bonds, has been quite, there's been a number of challenges and considerations, and the most effective and smooth way to transition. I think active is an option, but once again, Davina will go into more detail. Because considering the volumes out there, I think passive transition is probably the preferred or encouraged approach, but not through a protocol like you would see in derivatives, more using what is currently been looked at. And I think there's, Davina will cover this in the next slide, the use of this legislative approach. Davina, I think it's best to leave it with you there as you discuss or take us through the legislation.
Thanks, Kim. That's great. Thanks. I will do. Next slide. So basically, we're dealing with the SARB having released a set of amendments to the Financial Sector Regulation Act, which are really quite helpful. That has entered the parliamentary process, and it basically impacts all contracts or financial agreements or financial instruments that use an official benchmark that's being discontinued. And they provide that on the benchmark cessation date of a discontinued benchmark, a designated replacement is actually going to become operational by law, and it's going to replace the benchmark that was in the contract originally. And it covers contracts that either contain no fallback provisions or have a whole bunch of other criteria. For example, they don't specify a replacement, they don't identify a determining person, they don't provide for a permanent replacement, or they require the consent of a third party that hasn't been obtained. Next slide. So basically, there are some guardrails around that determining person under a legacy contract that's provided for. The legislation provides that a designated replacement benchmark must be determined by a determining person. So it can't be just any benchmark. It has to be one that's designated. There's also a designated adjustment spread that has to be recommended, and that benchmark conforming changes may need to be made to contracts. Selections need to be made by determining persons by no later than the benchmark cessation dates. And this is where the legislation becomes really helpful. It provides that in the event that this does not happen, there is an automatic process by which the contract will be able to be transitioned to the new designated rate that the SARB will determine via secondary legislation that will come out, or secondary regulation that may come out as a result of this. Just to give some sort of indication, the legislation provides that team or working groups will be set up for determining the relevant replacement benchmarks for different categories of instruments. That work needs to be undertaken, and there will be industry participation in those. And so there may be an outcome, for example, on the retail market. I think Paul mentioned it, to say, for example, maybe Zaronia is not the preferred approach on that for that market, but there'll be consultation engagement as to what may be the replacement. It may be determined to be something different. But essentially, the view is that most of the replacements will be to a Zaronia replacement, and the manner in which that will be able to work will all be determined by the legislative overrides, and it will impact everything that hasn't already yet been transitioned by the actual cessation date. The legislation itself is quite robust, and it is very effective, and it will assist a great deal where there are contracts that may be difficult to transition, or where parties haven't had an opportunity to agree or contract for what the new benchmark provisions will be. I think at this point, I hand over to Zwide on the loan side to take you through some of the loans before I come back to talk to you about bonds.
Morning, everyone. So yeah, the loan market, I think, is starting to gain a lot of traction from the Zaronia transition perspective. We're seeing quite an uptick in active transitioning. So, I mean, effectively, where parties are contracting on new loan agreements, but using JIBAR as the base rate, what we are seeing an encouraging a lot in the market is for parties to actually start introducing the rate switch language in their loan agreements. The rate switch language that I'm referring to is the language that's actually published by the LMA. Some of you might be familiar with it already. And effectively, that language essentially just provides for mechanics via which the instrument and the rate transitions from JIBAR to Zaronia on the rate switch date, which I think, as everyone is well aware, is fast approaching. It will be here sooner than we think. So contracting on those terms, I think, just obviously makes it a seamless process. And another behavior we're encouraging and actually implementing at the moment is where basically, you know, somewhat of an opportunistic approach where parties wish to enter into a refinancing or amend terms of a loan agreement, and we often take that opportunity and again encourage you know, lenders and borrowers to actually take that opportunity to introduce the LMA rate switch language, which provides for the mechanics to move from JIBAR to Zaronia. And then insofar as we don't have those opportunities at play, then, you know, we obviously entering into the repapering project and taking loan agreements and actually amending them to introduce language that will achieve the rate switch. The question that's often asked from the repapering perspective is, what about the CAS? And bearing in mind there is no CAS, how can one think about transitioning or introducing the language via which the contract in question moves from JIBAR to Zaronia? And the approach and the solution to the absence of a CAS that has actually been adopted is just to have language in loan agreements that effectively says when the rate switch occurs and when the rate switch is effective, the CAS will be the CAS that's published on Bloomberg and published by the relevant authority and calculated in accordance with the accepted methodology, which deals with actually not having a CAS that's, I think, widely used across the market as it stands. Then on tough legacy contracts, I think Davina has nicely positioned what the legislation is and what the approach will be there. So obviously, when we have a contract that maybe has been difficult to amend or hasn't been amended, then effectively parties will operate within a legislative framework to deal with the absence of a base rate in that context. Interesting, I think, knowledge from that perspective is there is case law that does deal with tough legacy contracts, albeit it is foreign case law, and in that case where the instrument was still referencing a rate that had since become extinct, the court in question actually deemed the contract to introduce a rate that was market related, and that was a LIBOR instrument. And what the court actually held was that, you know, it was an implied term that contract would move from LIBOR to term SOFR. So if we're not operating within the legislative framework as yet, and you're dealing with a tough legacy contract, there are at least grounds on which parties could argue that it's an implied term that, you know, one is contracting with reference to Zaronia. And then there's an interesting Section 45 Companies Act consideration, which we're often asked about, which is what does this mean for guarantors, where you've got a loan agreement that's guaranteed and the rate changes. Does this mean that you might need to have new Section 45 resolutions passed, because that might have financial assistance implications? And I think the general acceptance across the market is that that's not the case, because the intention of the change in the rate is not to put parties in a better or worse position than they would have been in had JIBAR continued. So guarantors wouldn't face increased exposure, and therefore you wouldn't need to introduce new Section 45 resolutions. And then another interesting consideration is term Zaronia and the impact it will have on parties who have contracted on the basis of the backward-looking rate. And the position at the moment is that, once or generally accepted position is that once term Zaronia is introduced, or if that ever is introduced, then parties would just have to contract on the basis of term Zaronia. So yeah, that's kind of what's happening in the loan space at the moment. Yolandi, we can move on to the next slide.
Thanks, Vida. I'm going to touch on the bond market really quickly. So we keep talking about this concept of active versus passive transition. Active transition is obviously where you don't rely on a legislative solution and you actually enter into a bilateral conversation to commence with a transition approach and documentation. The bond market has not particularly been in favour in South Africa for an active transition approach. Paul touched on the point that note holder consent is required, and there is a threshold of 2/3 required in terms of the JSE listing requirements in order to get note holder consent for that. And it's seen in the bond market as quite a big piece of work with over 2,000 instruments in issue. There's kind of a market consensus that a passive transition is probably preferred. What we mean by passive transition is that the legislative override, which I've referred to, would basically prevail, and parties would be able to enter into or to have their notes transitioned automatically by operation of law using whatever is the agreed determination for Zaronia, movement from JIBAR instruments to Zaronia instruments, and that would happen without needing the sort of the consent solicitation approach, which has happened in the offshore markets when the transition from LIBOR occurred. So that's definitely the preferred approach on a general consensus. That doesn't mean that you can't do a consent solicitation prior to the cessation date, and that it doesn't preclude that at all, but it's not the preferred outcome. The amendments will help with the bond market incredibly, because it will then obviously give you the optionality to either use the change in legislative solution as the approach, and the supporting of that passive approach will actually probably reduce the documentation process incredibly. As I said, this differs quite a bit from other markets. For example, in the US, actually it was all done on the basis of a passive approach, because the US had a very unique scenario in that actually unanimous consent of note holders was required for any amendments to bond terms, which meant that it would almost be impossible to obtain. The UK, for example, did not take the approach that they needed a passive approach. They went for an active transition approach because the thresholds were not so difficult to obtain as in the case of the US market, and so that was all notes were transitioned on a much more consent solicitation approach. Appears as though we are favouring a more passive approach like the US did for differing reasons, though. There may be a possibility that repapering of all applicable pricing supplements may need to take place. The good news is that there will be nothing required from note holders if we go for a passive approach to that. There'll be a notification process where everybody will be notified, and then possibly a repapering will happen via single notices and APSs, but there won't be a huge requirement of anybody to engage in lengthy legal processes for that. Just in terms of the buckets that Kim was talking about right in the beginning, in terms of anything that's issued currently that is still JIBAR linked, the Reserve Bank has published a fallback language, which is very specific to bonds. So Zwiedes touched on the fact that the LMA published some nice rate switch language, which contains all the fallbacks that are required. The same didn't exist for bonds, and ICMA wanted the market to determine that for themselves locally, and so didn't provide a firm guidance. Instead, the market consulted, and fallback language was drafted and has been published by SARB, and that is included in new bond issuance. So basically, you can issue a JIBAR instrument today. It will contain fallback language, so that on the cessation date, that instrument will be able to automatically transition based on the fallback language. It's actually called hardwired fallback language because it actually gives firm indications of what the transition to the new rate will be, and that is available and ready for use. There are 2 versions that are circulating, depending on which a particular bond issue would like to use, and those have been provided to the market by the SARB. And as we've already mentioned, no new JIBAR-linked bonds will be issued. The indications are from March next year, and we did. Paul already mentioned that we were very proud to have done the first Zaronia-linked floating rate bond in May this year. That's it from me. Handing over to Kim on the derivative side. Thank you.
Thanks very much. So on the derivative side, many of you will be familiar with the with ISDA, which is the International Swaps and Derivatives Association, because they've done a significant amount of work assisting the market with the likes of the SARB, who've also been facilitating this process to ensure that the derivatives market does transition in an effective and smooth way. The first consideration here is, again, we speak to those pillars that I initially discussed in the first slide, speaking to the legals, is Zaronia. If you enter, or a counterparty or parties agree to enter into a contract, a derivative contract, and they want to agree Zaronia, our ISDA agreement documentation reference a set of ISDA definitions, and a lot of what we do in the ISDA contracts are based on those definitions. So back in 2023 already, the latest version of the ISDA definitions, called the 2021 definitions, included Zaronia as a floating rate option. So counterparties can look to start including Zaronia based on the definitions, because the definitions are there for Zaronia, but only in the 2021 definitions. That's a very important point to make. If you wish to reference Zaronia in your derivatives contracts, your confirmation or your derivative documentation would have to reference the 2021 definitions and not the previous versions, not the 2006 version or the version before that. So if there's anything taken away from this point, please remember that the 2021 definitions are very important in respect of all the latest publications related to Zaronia. And then I think it was mentioned earlier by Vawani about the fallbacks, the ISDA fallbacks that were published in April 2025. Davina had mentioned hardwired fallbacks, and this is hardwired fallbacks because the definitions are very the fallbacks are very specific in terms of they reference what rate will apply, which will be Zaronia. So JIBAR will transition to Zaronia. It references the methodology that will apply, as well as the applicable convention that will apply to the backward-looking rate. So in that instance, ISDA published, there were 2 different publications. There was the ISDA definitions, which were updated. Again, it was the 2021 definitions updated. So any agreement entered into from, April 2025, when those definitions were published, and if your contract references the 2021 definitions, that will automatically incorporate the fallbacks in the 2021 definitions. So there's nothing that is required to be done. Unless counterparties do not want to incorporate incorporate those definitions. That will have to be a manual active transition. But if you have entered or counterparties have entered into a transaction as of April 2025, the specific date it just escapes me now. But from that date that publication was made and when the definitions became effective, any transaction entered into from that date will automatically incorporate the fallbacks. So again, nothing needs to be done. For your older JIBAR linked contracts, those that were entered into prior to the definitions being updated, there is the protocol option. I already mentioned the first slide. I won't go into much detail about that, but all that requires is adherence by both parties. If counterparties adhere to the protocol, the volumes of contracts, legacy contracts that were entered into, a year ago or so, will automatically be updated to incorporate those transactions. So it's a simple logging onto the ISDA website, adhering. I think there is a cost associated, associated with adhering to the protocol, and that relates to all JIBAR linked contracts, the definitions as well as the protocol. Because the fallbacks are incorporated, they're standardized, they're considered robust because there's a lot of work that's been done in them. And what you see, a very high level sort of understanding of what the provisions that the fallbacks include. Zaronia is the fallback rate, which is included in the fallback. So that is in the ISDA definitions as well as the protocol. There's a daily compound and arrears methodology, which is applied to Zaronia. The convention that will apply because it's a backward-looking rate, and counterparties would prefer to know the rate prior to the actual calculation date. There's a 2-day observation period shift that is applied. This is very much in line with what we've seen internationally with LIBOR. And then, of course, what we've already mentioned or has been spoken of, plus the ISDA credit adjustment spread is also included in those definitions. So in the fallbacks under the definitions and the protocol. So counterparties encouraged to consider the option of the protocol for legacy contracts, as well as considering that, going forward, we've got the standardized set of fallbacks. If you've ever entered into it and you got a JIBAR linked contract entered into from April 2025, that's also automatically including those standardized provisions, which a large portion of the market should be looking at applying. I think that's it from a legal perspective. I think we can move on to Junior, speaking about more of the derivatives market update.
Thank you, Kim. Morning, everyone. So the derivatives market is very much in the Zaronia adoption phase. And I'm just going to talk us through how we got to where we are at the moment, the developments we're seeing, as well as what we anticipate will play out in the next few months as we adopt Zaronia. So obviously, introducing Zaronia is the single most disruptive intervention that's taken place in Rand fixed income markets history. And I think it's been quite important that this gets managed in a way, given the timelines that we're working with, in a way that one leverages some of the progress and learnings from other jurisdictions that have gone through this reference rate reform, but at the same time adheres or at least honors some of the South Africa specific nuances of our market. We were guided primarily by the US market and their transition from LIBOR to SOFR, and simply because that is our largest partner as far as exchange trading is concerned in interest rate market, we developed a lot of our conventions to mimic the dollar market, and that would really allow for uniformity between our derivatives instruments and those managed in dollar markets and other jurisdictions. In that regard, convention changes pretty much mimic not too much changes other than conventions such as compounding and duration or rather frequency of flows, which will now be more annual and rather annual compounding and annual flows. But importantly, I think in respecting or honoring some of the South Africa specific nuances, the biggest place that we intervened or rather protected was in the front end of our curve. So if you look at speculation or hedging of interest rate or monetary policy path in most curves, or at least most markets, they're reliant on futures markets in terms of hedging that exposure. Our market is very much dependent on FRAs, forward rate agreements, which cannot really work in a OIS environment. And so part of what we've done there in the front end of our curve is pretty much develop what we refer to as forward starting single period swaps, which would essentially mimic FRAs with a slightly different tenor, 1 month instead of 3 months, but would allow for a swap curve to begin from pretty much T+0 as opposed to relying on a futures market. That's a very detailed but quite important intervention. As far as our curve is concerned, everything sub 2 year really forms the foundation of our entire yield curve. And the liquidity in the front end of our curve is really the bedrock of liquidity and informs at least market makers' abilities to show risk and market make further along the curve. So intervening there and changing or rather maintaining FRAs in a different form to allow for at least an impact-free change from JIBAR to Zaronia in the front end of the curve was probably an example of the biggest intervention to preserve some of the unique nuances in the South African market. As far as liquidity initiation and liquidity liftoff is concerned, some of the efforts were made to pretty much make sure that from an infrastructure point of view, most of our market is dependent on LCH and cleared swaps. And so testing that infrastructure, making sure that the incoming Zaronia derivatives can be cleared, can be traded bilaterally if necessary, was quite an important step, and that has been done. Most banks began displaying or rather publishing indicative prices, initiating early price discovery. And that was really to try to get the market going prior to any natural need for that market. We're right now in the liquidity liftoff phase, and really what you want to see there is continuous and relevant, price action, as well as increased volumes. And all of this comes together to really form what will be a market acceptance of Zaronia derivatives. Some of the key elements have been passed, so local bank participation can be checked off. ISDA protocol was approved and published earlier this year. And the key areas where we're experiencing a little bit of a lag, but is beginning to take off, is offshore bank participation as well as regulatory persuasion. Offshore bank participation is important in our market, and it's unique relative to some of our peer markets, simply because something like 95% of all interbank derivatives include at least one offshore bank, and that becomes important in bringing international banks along this journey as far as transitioning to Zaronia is concerned. You can move to the next slide, King. As far as regulatory persuasion is concerned, this is quite a big step, and in our market that came in the form of Zaronia first, really trying to encourage the use of Zaronia in the interbank market ahead of JIBAR. Some of the key principles that were taken into consideration here were, one, that these changes should not mean that there's a prohibition on the trading of JIBAR derivatives, but two, that liquidity provided from dealer to client should not be impacted as far as JIBAR is concerned. And that really was to preserve the integrity and liquidity of our markets as we transition to Zaronia. So what have we seen? So really, I think part of what we've observed has been a very slow adoption of Zaronia derivatives. In the last few months, something like less than 20 transactions have been recorded in the interbank market. And this has all been in a phase of what was considered Zaronia first. So we've done some thinking as to what's driving this. Is there bank resistance from this? Is there not enough of a persuasive principle as far as Zaronia first is concerned? And really some of the elements that have maybe plagued or hindered some of the liquidity buildup has actually been events that have occurred outside of the derivatives market. So if you take a look at when Zaronia first was meant to take over or be launched, you're talking about from end of April or beginning of May. Obviously, we've had a bout of extreme volatility in our markets and uncertainty, initially stemming from our budgeting process in February, March, where we, I think for the first time in at least my short history, failed to pass a budget. That obviously led to massive questions around the continuity of the governing GNU, and that brought in it maybe a reluctance by international banks to lean into the SA market, and obviously the ensuing volatility in both the bond market and derivative space. Added to that, we obviously had the tariff tantrum that occurred during the month of April, and that uncertainty was stretched out over a few weeks. And lastly, and maybe more recently, has been the announcement by the SARB of a inflation target change, which in itself brought a little bit more volatility in the market, at least initially. What these events really done is that it made it quite difficult for market makers to pause JIBAR trading and try to initiate a new sort of market in which there is no natural risk at the moment that dealers will have, but more an imperative or a preference to trade Zaronia first. I think most of those items that I've mentioned are starting to clear up. The markets are less anxious about tariffs coming out of the US. And obviously, as we've seen, the GNU has endured. We have a budget. And lastly, as far as the inflation target is concerned, while that is a very fresh development, I think the market is coming to terms with the implications thereof. At the same time, we're moving into, or we are in the middle of the Northern Hemisphere summer, which I think means that you see liquidity swing from offshore heavy to domestic heavy. And with domestic banks being, I think, probably the most eager to get the market going, we're starting to see a little bit of activity pick up. So while they've only been 20 recorded transactions or less, importantly, price discovery is becoming a little bit more consistent. Dealers are putting prices out, and those prices are relevant from the standpoint of bid-offer spreads. So when this all began in terms of liquidity initiation, bid-offer spreads were between 15 and 20 basis points, so not really anything usable. That's currently down to about 8 basis points. And while we aren't seeing people cross those spreads to trade, and again, that comes back to the lack of natural risk, what you are seeing is that dealers are prepared to show ever tighter prices. I think one thing that you can take away from this is that dealers are growing in comfort in terms of showing liquidity in Zaronia. This isn't impacting JIBAR. Specifically, some of the developments around ISDA protocol and certainty around the credit adjustment spread means that most banks, at least domestic, will have a decent amount of comfort in either showing you Zaronia or JIBAR risk in quite large scale and treating those two risks as fully fungible. And that's quite an important a mindset switch that we're seeing take place in real time, which will, A, preserve the liquidity of JIBAR, but start to see Zaronia liquidity get ever tighter and tighter. One other point, I think Paul touched on the concept of a term Zaronia, and I thought some of the learnings that we experienced when we transitioned from dollar LIBOR to SOFR would be useful in that regard. Firstly, in the dollar market, the slow offtake of SOFR was evident for several months. So I think the slow uptake of Zaronia is perfectly normal. Most individuals, again, will be loath to show risk where they do not naturally have underlying end user exposure in that specific reference. But what we did see is that when we initially engaged in trying to trade the new SOFR, bid-offer spreads were wide. In the dollar market, they were as wide as 10 basis points in a market that traditionally trades about half a basis point wide. And that did tighten fairly quickly. What took a while to tighten is your term SOFR rate, and primarily that stemmed from uncertainty from regulators in terms of whether it would be a preferred route or a discouraged route for banks to take, given that it would be pretty much going back to the original risks that existed in the IBORs. I think once that gets cleared up in our market, we'll see banks again begin to engage it. From there, what we saw was that it still remained less liquid than the overnight rate, primarily because the term rates were not cleared on LCH, which meant that transaction costs and implications were a little bit higher for banks, and that prevails till today. Spreads have tightened, I'm happy to report, in terms so far, and so I would imagine that terms Zaronia will go through a similar journey in which prices will initially be wide, the costs of trading will be wide, but those will slowly compress as a certainty from policymakers around their attitude towards the term rate becomes clear, but B, that the costs associated with holding such risk collapse closer to your overnight compounding swap rates. Leave it there.
Good morning, everyone. And thank you to all the presenters. We hope you found that a very informative session. I know there's been a lot of information shared, a lot of information included on these slides, which we will share after this, together with the answers to the Q&A that we've seen coming up in the Q&A section. We may not get through all of them shortly, but we will answer those and include those in the pack that we share. Just to summarize, where you can get a lot of the information directly yourself. You can obviously, any client engagement should be channeled directly with your client relationship teams. As an active member of the market practitioners group, we continue to engage and share industry developments through our Standard Bank Zaronia page. So the link will be included in the pack. Please go directly through that. We've got a lot of frequently asked questions on there, with a lot of the answers to the questions that have even been asked today. It was also mentioned earlier, we recently developed and launched a risk-free rate calculator using the recommended calculation methodology from the SARB, which you can use at your own discretion, and a lot of the other links to any of the other websites that include a lot of the Zaronia related information. We'll now move into our Q&A session. We had actually included and prepared for 2 questions, which are very common questions that Standard Bank gets. And then I will move into the posted questions when I will ask the rest of the presenters to come on screen as I direct them to the relevant person. So the first one is, what has Standard Bank been doing internally in preparation for this transition? So within Standard Bank, we have set up an internal project team within Treasury and Capital Management overseeing this critical transition. This project reports to an overarching steering committee. The project is underpinned by various internal work streams that are directly aligned to the external industry MPG work streams. Each work stream has very key roles and responsibilities and deliverables. Today, I just wanted to highlight some of the key focus areas. Some of them have actually been mentioned earlier. So measuring our reference rate exposures. We have been assessing all of our JIBAR exposures. We're now also tracking our Zaronia exposures, having started trading Zaronia. We tracking our notional values, number of trades, all of the systems impacted. Repapering or recontracting, the legal team, I think, went into a lot of detail around that, but making sure we can identify any fallback provisions or contractual terms that may provide for the transition. Then looking at the economics and financial reporting, we are very close to ensuring that we understand the changes to any of our contract cash flows, any impact on our hedging strategies, any impact on our financial reporting. So we've got a very key work stream monitoring all of that. Systems, processes, controls, obviously very key, and making sure that any changes required to any of these are very closely monitored. And then lastly, governance and a communication framework. Treating our customers fairly within that framework is very critical to us, making sure both our colleagues internally as well as all of our clients are kept up to date with any developments. So we will continue to do webinars like today, internal sessions if required, and making sure that everyone is up to speed with any of the impacts happening with the transition. The other question which has come up more frequently since we launched the risk-free calculator is, what is the purpose of the risk-free calculator? I will pass that over to Vawani, who was instrumental in the launch of this calculator.
Thank you very much, Carol. We've really, and we're pleased to actually announce that we've begun publishing the reference rate risk calculator on our website. And the good thing about this calculator is that it's available both for Zaronia as well as other G3 JIBAR rates as well, notably SOFA as well as SONIA as well. It's an educational tool. Its purpose is really to assist you with playing around with the various scenarios regarding the various conventions of how to calculate a backward-looking rate, together with also playing around with the impact of a credit adjustment spread as well. We still advocate that you reach out to the various relationship managers or the client teams to assist you as we begin to transition, so that you can get a better, fair, and accurate reflection of the true impact to your deals that will be transitioning, as well as the calculation of interest. Thanks, Carol.
Thank you, Bongani. All right, I'll move into the questions that have been posted on the chat. I'm not sure if we're going to have time to go through them all, but let's go through the handful that we can, and then, as I say, we will get back to them later on. The first one, Paul, will there be a term rate? I know you mentioned it in your slides. Maybe you can just add on to that, please.
Yeah, sure. Thanks, Carol. I think just to reiterate, certainly there is work going on at an industry level to develop a term rate. So there's been some thoughts around what the basis of that rate should be. It's important from a benchmark regulation perspective that rate in itself is compliant with benchmark regulation and the IOSCO principles. So it would need to be underpinned by large volumes of transactions, very transparent, the governance around how it's calculated, etc. So we're at a point where an RFP will go out to various vendors to become the calculation and publication agent of a term rate. Now, as you can imagine, that might take some time, one, for that RFP to go out, two, for the responses and the adjudication of that process, and three, for the MPG and SARB to select and ensure that they're comfortable that that term rate is appropriate. And then finally, how would that term rate be used? What would it be able to be used for? We've certainly seen internationally restrictions on the use of term rates, some more restrictive than others. So on balance, I think we expect that a term rate will likely be developed, but it's unclear that it'll be available with sufficient time for transition or indeed ahead of a cessation date. So I think it's important for market participants to get comfortable with compounded overnight rates. Thanks, Carol.
Thank you, Paul. Whilst you got your camera on, there was another question later on synthetic JIBAR. I think that was also included on your slides. Someone's asked, what does this mean and how will it play a role in the transition?
Yeah, it's such a good question. I think it really links to the legislative approach that we take to transition. So where active transition is more difficult, the approach would be to transition transactions to Zaronia. That would be the standard approach. But where that's not possible, and let's say a term rate's not available, then there may be a use case for a synthetic JIBAR. So it would be a very limited use case for instruments that need JIBAR post cessation of JIBAR, that a synthetic rate could be used. It wouldn't be available, I don't think, for new transactions, but be extended for a period of time. For example, while we were waiting for a term rate to be developed, so that JIBAR could continue within transactions for a limited period of time.
Excellent.
And it's unclear that that's going to be developed yet. So we have no certainty on that yet, but there will be more guidance towards the end of the year.
Great, thank you. Bongani, may I ask you to come on? We've got quite a few on CAS, so I'll try and link them together. But one prior to that is around, should Zaronia be used in current facilities being initiated now in order to avoid a requirement to transition later?
Thanks, Carol. That's actually a very good question. It actually rests on the readiness from both from a client as well as lender's perspective in order to consume Zaronia in their systems in calculating interest, and as well as the legal readiness as well. To the extent that systems, both from a client as well as from a bank perspective, and certainly from our point of view, we are fast tracking that readiness. So clients can actually approach us if they want Zaronia linked deals. It does make sense for clients to begin actually having conversations with the various client teams in order to start looking at transactions, concluding transactions using Zaronia. And I think at least by starting, there's nothing that stops us from actually doing that now, because the rate is actually available to the market for use. And certainly that has been the case during the adoption phase and as we move into the transition phase as well.
Thank you, Bongani. Okay, and let's move into the CAS specific questions. The first one is, what is the average credit adjustment spread you have observed for, say, a 10-year JIBAR linked loan? I'm not sure if you would have that to hand.
Yeah, so the credit adjustment spread is designed to ensure fairness when transitioning the benchmark rate JIBAR to Zaronia. It is independent of the contractual tenor of a deal. In other words, it's contractual tenor agnostic. A 1-year deal and a 10-year deal that are currently referencing 3-month JIBAR will transition to the same credit adjustment spread. Meaning, if we just look back to the examples that we spoke about earlier, where credit adjustment spread for 3-month JIBAR is 17 basis points, it will be the same for any deal regardless of its tenor. Thanks, Carol. I hope that provides better clarity in terms of the role of credit adjustment spreads.
Thank you. I think that probably also answers, there was another one on how does one know that the CAS is fair and correct on a particular deal?
Yeah, so that I can also respond to as well, because I think there's a lot of questions around that. The fact that the credit adjustment spread is based on an approved methodology, which is calculated by taking the historical median difference of SOFR compounded and 3-month JIBAR and take that median of the 5-year historical difference. And together with the fact that it is going to be published, and it is certainly being published in Bloomberg as well, means that all market participants will have the same reference of credit adjustment spreads that they can use. So in other words, there's less ambiguity or subjectivity to the extent that we all adhere or use the credit adjustment spread as recommended by the South African Reserve Bank in actually transitioning contracts. That's meaning that everyone will actually use the same credit adjustment spread in that regard as negotiations happen when transitioning deals.
Thanks, Bongani. So you've definitely then answered there was another one. Will different banks have different credit adjustment spreads? I think you've then answered that. Does using a backward-looking overnight rate introduce more rate volatility for borrowers compared to a fixed-term rate like JIBAR?
That's also a good question as well, Carol. I think the complexity comes to... Sorry, you wanted to hear something else?
No, go ahead.
Okay. I think the complexity comes in terms of how Zaronia interest will be calculated, in that with the current regime of JIBAR, you will know upfront what the JIBAR rate will be that will apply for a specific interest period. The difference with Zaronia is that it's a rate that is calculated overnight on a compounded basis and observed in arrears. And the look-back period that is set for the various contracts aims to ensure that market participants at least have better certainty of what that final compounded interest rate will be closer to the end of the interest period. For example, a deal that's referencing Zaronia compounded in arrears with 5 business days look back means that the final compounded interest rate will only be known 5 business days before the interest payment is due. Is the rate more volatile as compared to JIBAR? The fact that the rate is overnight by itself means that it can change on a daily basis. However, you really expect a significant change in that rate as and when the South African Reserve Bank makes changes to the repo rate. This is slightly different to JIBAR, which anticipates that repo rate change, whereas Zaronia will only change at that point in time. A good reassuring thing about that is that to the extent that you're compounding, you are likely to feel that impact of the rate change over a longer period, purely because you're compounding that rate over a longer period instead of you seeing the rate as shifting significantly on a simple basis where the rate is not compounding and interest is calculated daily, similar to prime.
Excellent. Thanks, Barney. I think that's most of the CAS questions, but as I say, we can answer all of the others specifically in the pack when we share that afterwards. In the interest of time, I see a couple of loans and legal questions. So I'm going to just pose 2 more questions and then I think we'll close there. So to the legal team, it's probably in Zwide's space. How will syndicated loans be managed in the transition?
So yeah, so syndicated loans, I think the approach that we're taking is, one, we are working very closely with the market practitioners group to create a standardized form of amendment agreement that will be rolled out across the market to implement the rate switch contractually. So the idea is to adopt that form of amendment agreement amongst all the major banks, such that when syndicated loan agreements need to be amended, we're not in a position where we're heavily negotiating what the document should say or what it should look like and how it should work. And hopefully in the syndicated space, that will make the role of the agent affecting the amendments seamless and swift.
Thank you, Zwide. So who would be who would drive the changes? Will it be the arranger, or is the onus on the holder of the instrument?
Yeah. So I mean, I think that given the changes are actually based off what the market has accepted, right? So you've got, and when I say that, I mean the accepted language that has come out of the LMA. Now we're just agreeing, I think, a form of document that houses the language that the market has actually accepted, like this amendment agreement. But the process would actually be driven by the agents, hand in glove with the banks themselves. But the idea is to kind of future-proof the process by landing an agreed form of document with the banks via the MPG, and then facility agents will be well placed to roll it out, and there won't be too much back and forth between all the syndicated parties, because the market would have accepted the position already, and that process will be driven by the facility agents.
Excellent. Thank you very much. I think we will close there. As I say, all of this information will be shared with all of you, with all of the questions answered. And please do also refer to all the links that I mentioned before the Q&A. But thank you again for joining us today. We hope you have found this informative, and please do continue to reach out to any of your client engagement teams with any further questions. Thank you, everyone.